Working on your feet for 12 hours straight becomes its own kind of pain by evening, dull and aching, climbing from your heels into your lower back. Nurses, cooks, retail workers, and mechanics know the moment when shoes stop being an object and become the enemy. The shoes that helped many of them survive an entire shift were Crocs. The same plastic clogs the rest of the world spent years treating as a personal insult to human taste. Today, those clogs walk Paris runways, sell through celebrity collaborations, and generate billions. But Crocs nearly died twice, and both times, the same thing was killing it. A winning formula pushed beyond its limits. Boat shoes. Someone could laugh at Crocs for months. Then they bought one pair, just for home. A few weeks later, they were wearing them outside. That was how the shoes won people over, one person at a time, against their own mockery. Although they were never designed for people walking on pavement, they were lightweight boat shoes. They resisted water, gripped wet decks, and could float. In 2002, the first pairs were shown at a boat show in Florida. They sold out quickly, but the real market was much larger than yachts. Crocs were adopted by people who cared more about surviving a work shift than making an impression. They were easy to wash. They dried quickly. You could slip them on in seconds. The product went mainstream almost in spite of how it looked. And the success came so quickly that management reached a conclusion that seemed reasonable at the time. If one clog sold this well, the brand could sell much more. In 2004, the costume team for Idiocracy was looking for cheap shoes for a dumbed-down future humanity. They were shown plastic clogs made by a little-known startup. Director Mike Judge later recalled that they looked like perfect shoes for the future, and so stupid that they seemed impossible to become popular. While the film waited for release, Crocs proved the opposite. The company grew at extraordinary speed. Sandals, boots, hiking shoes, golf shoes, new stores, new markets, hundreds of models and variations. Crocs no longer wanted to be a one-clog company. It wanted to become a footwear empire. And beside that growth stood a man who captured the energy of the young company. One of the three founders, George Bodecker, was almost as unpredictable as Crocs itself. After leaving the board, he continued appearing in police reports. Once, after police found him in a running Porsche and detained him on suspicion of drunk driving, Bodecker claimed that his girlfriend, Taylor Swift, had been driving. The singer had nothing to do with him or the car. That did not bring Crocs down, and it does not explain the company's financial crisis. But the episode captured the atmosphere around a brand that was growing faster than it could mature as a company. The real cause of the collapse was not in police records. It was sitting in warehouses, in shoes nobody wanted to buy. $1.05. Crocs built production and purchased inventory for a future in which growth never stopped. For a while, the formula really worked. The more models, markets, and inventory the company added, the faster it grew. But the clog was a phenomenon. Most of the new categories were not. When demand slowed, shoes kept arriving in warehouses faster than they left stores. Then, the 2008 financial crisis began. It did not create Crocs' problem. It simply exposed the limit of a strategy that had previously delivered victory. The number of pairs sold fell by nearly a quarter. Crocs posted a net loss of roughly $185 million for the year. The company closed production facilities, wrote down inventory, and cut jobs. For employees, this was not a line in a report. It was a vanished paycheck and a sudden question. How could a company that could barely make shoes fast enough yesterday be unable to sell them today? The market gave its answer. In November 2008, Crocs stock fell to $1.05, the number you remembered from the beginning. A year earlier, the same stock had traded at around $75, a collapse of almost 99%. The first growth formula had reached its limit. Surgeon's cut. For the next several years, Crocs survived, cut costs, and tried to restore growth. In early 2014, Blackstone invested $200 million in the company. A few months later, Andrew Rees became president of Crocs. He was the opposite of the energy that had driven the company's earlier expansion. Not a flamboyant founder, not a man of legend, an operator who asked boring questions and demanded specific answers. Picture him walking through a warehouse, past racks of golf shoes, hiking boots, and hundreds of models that half the company barely knew existed. He stops and asks, "Who buys this?" And no one beside him can answer. Those uncomfortable walks produced 3 questions that would define his entire strategy. Why did the company need so many products? Which models actually made money? What would remain if Crocs removed everything customers did not come to Crocs for? The answer was surgery. The company cut the product line, closed weak categories, and simplified its production model. It was a risky bet. After all the cuts, the same plastic clog the internet had mocked was once again at the center. If people had truly grown tired of it, Crocs would have carefully cut away everything else and left a dead product inside. But Rees bet on the opposite. The clog was not the problem. The problem was that the company had stopped understanding why people needed it. For years, Crocs tried to justify its appearance with comfort, as if it were saying, "Yes, we are ugly, but at least we do not hurt your feet." The new strategy stopped asking for permission. Yes, we look strange. So what? The Come As You Are campaign turned the brand's flaw into its position. Crocs no longer tried to please everyone. Polarization became proof of recognition. In 2017, Balenciaga sent platform Crocs worth hundreds of dollars down the runway. They sold out. Then came collaborations with Post Malone, Justin Bieber, Bad Bunny, and KFC. Every new pair triggered the same reaction. Who would even buy that? And that was exactly why people talked about it. The second growth formula was almost the opposite of the first. Do not make more different products. Make one product mean more. Jibbitz became the clearest symbol of that formula. It began not in a boardroom, but in the basement of an ordinary home. Sherry Schmelzer sat among homemade charms and tiny decorations, pushing them one by one into the holes of her daughter's clogs. Not for a market, not for investors, just to make a child's shoes more fun. Her family was the first to see the holes in Crocs not as ventilation, but as empty spaces for personalization. There, on a basement floor, the Jibbitz company was born. Crocs bought it for $10 million in 2006. By the mid-2020s, those tiny charms were generating roughly $250 million a year for the brand. The same pair could look completely different. Letters, food, bands, characters, private jokes. The clog became a platform, and Jibbitz became something like video game skins, only worn on your feet. Customers could return for new decorations without replacing the shoes themselves. Crocs found a way to expand without running away from its core product. Then the world itself began living by Crocs' rules. Comeback machine. In 2020, millions of people stopped going to offices. Formal clothing disappeared from everyday life, and comfort no longer needed an excuse. The pandemic did not create Crocs' comeback. The company had already cut the excess, restored its cultural relevance, and built an economy around personalization. But the pandemic stepped on the gas. In 2021, Crocs' revenue exceeded $2.3 billion. In November, the stock climbed above $180. That $1.05 had increased more than 170 times. The market had nearly written the company off. 13 years later, it valued every share hundreds of times higher. The second growth formula had worked. Focus, cultural relevance, one product that could be reinvented endlessly. But success created another blind spot. Blind spot. Picture Crocs at the end of 2021, the best year in its history. The stock was more valuable than ever. The clog was a cultural phenomenon again. And from that peak, the company made the biggest move of its life. It announced the acquisition of Hey Dude, the largest deal in its history. Hey Dude had a story that strangely resembled the early story of Crocs itself. It was a small brand born in Italy in 2008, the same year Crocs stock traded at $1.05. It made unexpectedly comfortable, lightweight shoes that people bought not for how they looked, but for how they felt. Perhaps that was why the deal seemed so logical. Crocs seemed to be buying its own reflection, confident it knew how to turn it into a phenomenon. This was not an insane decision, quite the opposite. It grew out of the success of the new Crocs. The company had learned how to turn unusual, comfortable footwear into a cultural event. Now, it believed it could do it again. That is how a strong strategy begins to become dangerous. Not when it stops working, but when management starts believing it will work everywhere. Later, demand for Hey Dude weakened. Too much inventory accumulated in sales channels, and investors filed lawsuits alleging that management had painted an overly optimistic picture of growth. Those were allegations, not facts established by a court. But the deterioration of the business was already visible in the company's reports. And in 2025, Crocs acknowledged what the market had suspected for a long time. Almost 1/3 of the price paid for Hey Dude had been impaired. It simply disappeared from the balance sheet. The core Crocs brand remained a large and profitable business. The company was not back on the edge of bankruptcy. And this was not an exact replay of 2008, but the rhyme was obvious. The first time, Crocs believed too strongly that one successful product would allow it to sell everything. The second time, it believed one successful system would allow it to repeat success with another brand. George Bodecker helped turn strange boat shoes into a global phenomenon. His era showed how quickly Crocs could grow and how dangerous it was to believe that growth would never end. Andrew Rees made almost the opposite bet. He cut the excess, restored focus, and built a new cultural and financial machine around one clog. Both approaches worked, and both eventually created their own blind spot. The first Crocs believed too strongly in expanding the product line. The second believed that the success of its core brand could be transferred painlessly to another. So this is not a story about a bad founder and a good operator. And it is not a story saying expansion is always bad while focus is always right. It is a story about two formulas for success, each becoming dangerous the moment management stopped seeing its limits. Companies rarely fail because everything they did was wrong. More often, they are betrayed by a strategy that stayed right for too long. In 2008, The market valued Crocs at $1.05 per share. What saved it was understanding that one ugly product did not have to be a limitation. But even the right lesson stops saving a company when it begins treating that lesson as universal. And somewhere, right now, a nurse is finishing a 12-hour shift in the shoes the entire internet once mocked. She does not care which growth formula appears in the company's strategy. She cares that her feet do not hurt at the end of the shift. As long as the company remembers that person, it has a chance to survive any formula it creates. And one last thing. Right now, somewhere, a company has a formula delivering a record year. And somewhere inside that formula, a blind spot is already growing. No one has named it yet. Every empire leaves a body. We do the autopsy.